Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, and they have been fun to speak about so far, obviously, in 2023. Gold's off to its best start, Miles, since 2012, which actually, that means, with us crossing 1940, we're officially in a bull market. So you can say gold's in a bull market because we're up $100 just in 2023 alone, and 5 consecutive weekly gains. Show us these charts, and where do we stop, and do we take a breather?
Yeah, not just 5 consecutive weekly gains, but 11 out of the last 13 weeks. When we started going up, 11 of 13 weeks were all up weeks. So we're up about $340, over 20% since November 2nd. And we're kind of nearing the last little section in here where you could see some standing sell orders to push the price back down. Obviously, we're significantly overbought now at this point. We talked about that last week, and then lo and behold, gold didn't turn around, and it certainly didn't just sit sideways. We got a big boom up here over the last week in the price of gold, now sitting in the mid-1900s. So this is what we were talking about last week. Sometimes the masses just sort of take over. And sometimes you just get these parabolic moves where you kind of throw a reason out the window for a few weeks, see just where the pieces end up lying. So it looks like with the FOMC coming up next week and another anticipated interest rate hike, it's very likely you could see gold and other commodities, which I'm also going to look at here before we finish up today. I pulled a couple numbers for a few different things reminiscent of, well, I don't have to do this anymore, but I know anybody who's trying to buy eggs at the grocery store right now is pretty disappointed. I'm looking back 2 years ago and being grateful for the chicken coop I built.
You didn't buy eggs, you bought chickens.
Yeah, that paid for itself. Wisdom. Yeah, that was very expensive, but it somehow managed to pay for itself all in about the last month here in Colorado, now that eggs are about $10 a dozen. Guess what? It's not just golden eggs. Not golden eggs, gold and eggs.
You bought the golden hen. I got it. All right.
It's gold, eggs, and additional commodities we'll look at too. So with the rise in gold, you brought something up just a second ago. There's something in gold that isn't quite doing as well as gold, Tori. What's that?
Paper gold is not doing as well. And, it's fascinating here. You just talked about this $320, $340 rally in the gold price since November. And yet ETFs are sitting at a 2-year low. And they've really, through that entire move, they've remained unchanged, stuck at about 94 million ounces. All of this activity, as we've talked about on the show, has been physical buying. Central banks don't buy ETFs. Central banks buy the physical gold that, with Basel III, physical gold was reclassified as a tier 1 asset, meaning zero risk. So why are they going to go buy a paper form of something that is not the pure hedge and go buy the actual physical gold? So this is all occurring in the physical market with some, obviously, leverage in the futures options trading.
So let's take a look at some of those other commodities. We'll start out with the other metals we like to talk about. Silver, I mentioned this last week. It looked like silver was kind of planing out, looking to start trading a little sideways. It has continued to do that. It has not put in another higher high. But unlike what I expected last week, we also haven't put in a real lower low either. And it's just sort of parked just under $24 right now. I have another long-standing rule in trading is reversals tend to happen fairly quickly. Continuations tend to take time. So when you see things slow down and catch their breath but not reverse, you tend to not see the reversal come in the next couple weeks or months. So I would argue the longer we see silver sit stagnant here, the more likely it is to not reverse and continue up. And looking over at platinum, I still had some notes written on my chart from a couple weeks ago, so I love when this tends to work out the way I wanted it to. But I talked about platinum going up and stopping at around 1117, 1118, and then looking at maybe making a pullback to 925. Well, lo and behold, we've gone up and we've stopped at around 1118, and we've pulled back now to about 1040. So I'm pretty happy with that guess a couple weeks ago, but but 925 is still quite a ways down, although it's certainly likely, especially next week, if we see the interest rate rise. We've had so much strength across the board in commodities, except for one that I'm going to point out here in a second, but that's relative. So much strength here in the commodities across the board. I really think this is just a couple weeks of buy the rumor, sell the news. So it's an issue of how high can we get commodities so that when interest rates go up next week and we do see a bit of a pullback, the pullback becomes less devastating. Gold going up $50 over the last 2 months and then dropping 40 because of an interest rate rise. That's a lot bigger of a percentage than gold going up $340 like it has. And then maybe next week, over the next couple of weeks, if we do get a pullback because of FOMC, sure, it could be bigger, $100. But 100 out of 350 is a lot smaller percentage.
Yeah, we'll take it. And I'm interested to see what occurs. I think it's going to be fascinating with these white metals and commodities in general. I'm excited to get to this point with you. But with all signs pointing to a recession, it appears that we've been deeply entrenched in a recession. We have layoffs up 795% just from September, which is absorbing 2 quarters of quote-unquote recession before they tried to change the definition of what a recession is. We're in a recession, and so that tends to put downward pressure on commodities prices, and yet you're not really seeing that. And so getting into some of that, silver's had a little bit of a rally here. It had faltered. The ratio got almost to 84-1, and now we're back down to 80-1 as it ticked up here today. But I would love to see us, again, take a little bit of a breather, establish a new base, and I have every bit of confidence that we're going to see much higher highs later in the year. So handing this back over to you, let's talk a little bit about the dollar and its role in some of this.
Sure. What interests me about the dollar is this decline that we've had. You know, you and I talked about this a couple weeks ago. I would have loved to see something build here over the last few weeks that looked kind of like the creation of a head and shoulders pattern, moving down, coming back up, which we didn't do. We're still going down in the dollar, and then looking at reversing back down from that point. I was kind of looking at the dollar compared to, say, how interest rates have risen over the last year. The dollar has now declined about half of what it did going back to, say, the start of 2021. So when the dollar started climbing, it was just below 90. It was like 88, 89. We got up to about 114, 115. So we've actually reversed back down about half of what we've gone up. On the flip side of that, interest rates, of course, have gone from basically 0 to 4.5%. So there was a period of time there up until about November, same time gold turned around, where interest rates had continued to climb and therefore the dollar climbed. That was expected. But what we've seen since then is the sell-off in the dollar, which has been pretty significant. I mean, the last time the dollar index was down at 101.6, which is where we're at now, interest rates were down at like 2.25. So interest rates have increased twofold, and yet we've come back down to those same levels. So I'll be intrigued to see how the dollar index responds next week on the expected interest rate rise again. Maybe the dollar's expecting us to get a little bit of a break. I've joked about taking the punch bowl away enough over the last month, so I'm not going to do it to you again. But maybe we're anticipating a little bit of a pause, at least, in the interest rate rise. I don't see it happening.
Yeah, I think the consensus is really just a 25 basis point. I mean, that's now almost nearing 100% in terms of those expectations. But that dollar at a 7-month low, of course, that should correspond. Again, we won't show the chart from a couple weeks ago either where we showed the dollar versus gold, but there is a pretty fascinating inverse relationship right now. But what you're also seeing, which is something that plays out somewhat consistently, is bond yields compared to gold. So those bond yields remain subdued right now also. So what's going to happen with the U.S. dollar index, with bond yields, with commodities prices if the Federal Reserve raises rates next week? What happens, obviously, with the gold and silver platinum prices? A lot of it is almost having less and less impact than it did in those first 5 months of that interest rate policy. And again, right now, to me, if we look at all the underlying fundamentals that tie into the gold price, it seems as if the wind in the sale of gold has been building because all of those fundamentals are kind of pointing to a continuation of the price climb, even with a potential little pullback.
Right, and you can see it in the S&P and the NASDAQ and the Dow, where you're seeing a pretty clear line in the sand that's declining down on the equities market just as a whole. I mean, the equities market, especially the S&P, has had a little bit of a bounce since that same time frame, kind of end of September, beginning of November. But we're still down like 16.5% over the last year, and we're definitely losing momentum there and the expected interest rate climb next week. So it's all kind of hinging around a whole lot of this buy the rumor, sell the news taking place really across the board. So I mentioned other commodities. I thought this was worth bringing up. So copper up about 40% since June of last year. All commodities are climbing. Copper's now about 17% away from its all-time high. So we're going to see that just like gold and a lot of other things. Cattle futures, 100% in 2 years. Cattle futures have doubled in the last 2 years. Interest rates have not been going up for 2 years. They've been going up for 1 year. So a good chunk of that happened in anticipation of all of these problems coming that Jerome Powell's just now trying to solve. Corn futures, paltry 120% in 18 months. Soybeans up 87% in the last 18 months. Brent crude, get this, 440% since 2020. U.S. retail gas prices up 52% on average across the board. We had that little spike there where like $4 or $5 gas was common, and somehow that was such a big jump. We all sort of fixed that in our heads. But we forgot it went back down again, and it slowly crept up over the last 2 years. So Brent crude's up 400%, retail gas is up 50%. There's a little bit of a windfall in there that may have to get made up somehow over time, depending on how U.S. oil reserves end up working out. So my gut tells me we might see more increased gas prices. And the last one I want to end on, you may remember a couple years ago, natural gas had that really weird spike where it went up like 600%.
Yeah, almost to 9.
Yeah, so natural gas is the one thing that has been just cratering over the last few months. So natural gas completely cratering sounds really good, right? It's come way, way down. Well, now it's only up 120% over the last 2 years. So you get rid of that spike, that 600% spike, and natural gas is up 120%. All commodities across the board that we need, use, and love in almost every product that we need, use, and love on a day-to-day basis, from corn and soybeans to cattle, natural gas. The one that's down or not increasing as much, of course, is lumber, but everything else across the board.
And that spike last year in natural gas corresponded with the Russian-Ukraine tensions and the invasion and everything else. You can look at the gold chart and see a similar spike where we went to that 2075 or so and ended up erasing that and coming all the way back down to sub 1600 because we were already in a decline at that point. So even taking that out, where we sit now compared to 2 years ago, gold would be in that same category of having really good returns. We are starting to see tensions building and increasing. Now we're talking about sending tanks to Ukraine. That to me is a major red flag and a line to be crossed. So eyes on that. Are we building for some sort of catalyst like we talked last week? I can't imagine the Fed pivoting. I can't imagine them not raising rates next week. That's just going to recatalyze inflation. It's going to be too early. There is the issue that they've got slowing growth. The stocks are going to roll over and continue their bearish trend, and they're going to have to figure out what to do with that. But you've got a couple forms of pivot. They can stop raising interest rates. They could lower interest rates. They could tighten more than what they actually have and start to reduce their balance sheet. And you and I have covered that on this show multiple times. Those are all things that we don't see playing out right now. And so because that's not going to be the case for a while, I don't expect you to see a whole lot of fireworks.
So that's going to do it this week on a very anticipatory Golden Rule Radio. We will be back with you next week, hot on the heels of the FOMC announcement, and see how the markets respond and react. So thank you this week for joining us once again. YouTube things, like button, subscribe button. Better yet, why not give us a buzz? You can reach us anytime. Call, talk to one of the advisors here at McIlvaney Precious Metals about your personal portfolio. We can be reached at 800-525-9556. And you can find more information on our website, McIlvaney.com. We're also on Facebook at McIlvaney Financial and Twitter at ICA Gold. Thanks again for listening. Hope you have a great week.